Hey everyone, welcome back to Corporate Decoder. Today PXS just filed an S-1 amendment, which is a big deal for their planned stock offering, and I'm seeing a lot of important details about their business and risks. Quick note, this is not financial advice, just my take on public filings for educational purposes. PXS Tankers is trying to raise about $18 million by selling preferred stock, but the health of their business and the volatile shipping market are raising some serious questions. So, we're looking at PXS Tankers Inc. They're filing with the SEC to offer up 800,000 shares of their new 7% Series B convertible preferred stock. This is essentially them trying to raise money by selling a new type of stock. They're hoping to bring in about $18.3 million after expenses, and if the underwriters exercise their option, that could be over $21 million. This money is earmarked for general corporate purposes, which often means buying more ships or paying down debt. Now, what is special about this Series B preferred stock? It pays a pretty solid dividend of 7% on its value, which is $1.75 per S-share per year, paid out monthly. But here is the kicker, it can be converted into common stock. They're planning for this to convert into about 1.3 million common shares. Based on a conversion price of $15 a share, this preferred stock ranks higher than their common stock when it comes to getting paid back, especially if the company goes through tough times. But before we get too excited about dividends, let's dive into the risks. PXS Tankers operates in a super tough industry, shipping specifically product tankers and dry bulk carriers. This business is highly dependent on global trade, and right now that is facing a lot of uncertainty. The filing specifically highlights the ongoing conflicts in Ukraine and the Middle East, plus rising inflation and interest rates. These aren't just headlines, they directly impact shipping costs, demand for goods, and the overall economic stability needed for companies like PXS to thrive. They're worried that these global events could really hurt their business and financial results. Let's talk about PXS Tankers itself. As of mid-2026, they operate a fleet of 3 product tankers and 3 dry bulk carriers. Their product tankers are mid-sized, averaging about 11.8 years old. Their dry bulk carriers are a bit younger, averaging 10.5 years. They're trying to grow by buying modern ships. The whole industry is facing pressure to be more eco-friendly, and PXS mentions their ships have ballast water treatment systems and 2 of their bulkers have scrubbers, which help reduce emissions and save on fuel costs. Looking at their fleet specifically, as of the 15th of June 2026, they have 3 product tankers, PXS Lambda, PXS Theta, and PXS Carteria. Then they have 3 dry bulk carriers, Conquer Orme, Conquer Asteri, and Conquer Venture. These are all on time charters, meaning they're rented out for a set period, which provides some predictable income. Now for the numbers, in 2025, PXS Tankers brought in about $39 million in revenue, a pretty significant drop from $51.5 million in 2024. Their net income also took a hit, falling to just under $2 million in 2025 compared to almost $13 million in 2024. This is a big deal, showing the market pressures they're facing. The daily revenue they're getting for their tanker business, known as TCE, dropped from over $29,000 a day in 2024 to about $21,000 a day in 2025. Their dry bulk business also saw its daily TCE fall from over $15,000 to about $14,000. While their utilization, meaning how much of the time their ships are actually earning money, went up slightly, the lower rates are clearly impacting their bottom line. Back in 2024, they had strong revenues from spot voyages, almost $20 million. But by 2025, that dropped dramatically to just over $2 million. This shift from spot market, where rates can be higher but more unpredictable, to longer term charters, likely reflects a strategy to stabilize income in a volatile market. Let's look at their debt situation. As of the 31st of March 2026, they have about $85.2 million in long-term debt. This is a significant amount for a company with a market cap around $46 million. They do have a decent amount of cash, over $55 million combined in cash and short-term investments, which is good for short-term liquidity. However, a large chunk of their business, specifically 2 dry bulk carriers, is structured as joint ventures with an entity related to their CEO. While consolidated for financial reporting, this structure adds complexity and potential risks, especially if they need to provide financial support. The filing really drills down into the risks of the shipping industry. They single out geopolitical conflicts as a major concern, mentioning how the Ukraine war and Middle East tensions have disrupted trade routes, caused price volatility for oil and fuel, and even led to one of their tankers, the PXS Carteria, being anchored in a conflict zone for over 100 days. They're trying to get reimbursed by their charterer for extra crew wages during that time, but there is no guarantee they'll get that money back. This really highlights how unpredictable and risky operating in these international waters can be. PXS Tankers' strategy is to operate a diversified fleet of modern eco-efficient vessels and to grow opportunistically. They want to benefit from trends in both the product tanker and dry bulk sectors, aiming for a balanced mix of time charters and spot market exposure. They're also focused on optimizing operating efficiency with technologies to save fuel and reduce emissions. However, the filing also points out that they may not be able to renew charters profitably, and that an oversupply of vessels could drive down rates and values. One of the key risks for anyone investing in this preferred stock is linked to the market itself. The filing states there is no established trading market for the Series B preferred shares right now, and that their listing on NASDAQ is not guaranteed. If NASDAQ doesn't approve their application, this whole offering might not even happen. And even if it does get listed, there is no assurance a liquid market will develop, meaning it could be hard to sell these shares. Scroll certain relationships and related party transactions. See Center, we also need to talk about related parties. Their CEO, Valentios Valentis, has significant ties to Maritime Corp and Concar shipping agencies. These companies manage PXS vessels and provide administrative services. While this setup has been in place for a while, the filing acknowledges potential conflicts of interest. For example, PXS CEO also owns other dry bulk carriers that are not equipped with scrubbers, unlike some of PXS vessels, which could create competitive disadvantages. Plus, with their CEO and his affiliates owning nearly 59% of the company's common stock, they hold a lot of voting power, which could impact decisions that are best for all shareholders. Looking at the balance sheet at the end of 2025, PXS had about $193 million in total assets, but within that, they had $133 million in vessels, which are subject to market value fluctuations. Their total liabilities were around $90 million, and stockholders' equity was about $103 million. It is important to remember that the value of those vessels can change significantly, impacting their ability to meet loan covenants if values drop. The big story in their income statement for 2025 is the drop in revenues to $39 million, down from $51.5 million in 2024. Their net income also plummeted from $12.8 million in 2024 to less than $2 million in 2025. This really shows the challenging market conditions they are navigating. They're also dealing with ongoing ship management fees from related parties, which totaled almost $4 million in 2025. While these arrangements provide essential services, they also represent a significant ongoing cost that directly impacts their profitability. The file mentions that the fees are adjusted annually for inflation, so these costs are likely to continue to rise. Scroll report of independent registered public accounting firm Center. And finally, the auditors Deloitte Certified Public Accountants give a clean opinion on the 2025 financial statements, stating they present fairly. However, this doesn't erase the business risks highlighted throughout the filing. The critical audit matters section is empty, meaning no major accounting issues were flagged by the auditors in 2025, which is a positive sign. Overall, this filing paints a picture of a company operating in a very tough and global industry, facing significant risks from geopolitical events, market volatility, and increasing operational costs. While they're trying to raise capital and maintain their fleet, investors need to be aware of the considerable challenges ahead, especially concerning the uncertain market for their preferred stock and the potential impact of global conflicts on their bottom line. The risk I am watching is how they will perform in this challenging shipping environment and whether this preferred stock offering will provide enough runway. That is my take. Stay decoded. If you found this insight helpful, please like and subscribe and check out the tools in the description.